Hi, this is Matthew Cratter from Trader University, and today I want to talk about my outlook for the stock market over the coming months. I've been getting a lot of questions about, are we headed toward a stock market crash, a stock market melt up, or what? So I wanted to kind of take a look at both the bull and bear sides of things, and maybe if we put our heads together, we can come up with a conclusion to this. So definitely be interested in your input in the comments below. And if you're interested in videos like this, and stock market outlooks, etc., trading strategies, be sure to hit that subscribe button. So any analysis of the stock market needs to begin with the fact that we're trading very close here to all-time highs, maybe 5-6% off the highs. And that's a very strange thing. You would expect that we'd be trading more down here where we were at the end of 2018. Now, why is that? Well, we've had a yield curve inversion. Sometimes this takes longer to play out. It can even take a year or two to play out, but definitely a bearish sign when the Treasury yield curve inverts. We have the ongoing trade war with China, and we seem to have a new tweet every couple days that whipsaws the market, and it's been quite confusing to follow. And on top of that, recession is already apparent in parts of the manufacturing sector and parts of the U.S. So the amazing thing is basically the strength of this market in the light of all of that. And you can see that we're trading, if we kind of scroll in, we're trading also near the highs of the recent trading range that we've been in since, call it midsummer. We're closer to the highs of that trading range than the lows in spite of all this. So that itself, that kind of price action is a fairly bullish sign. Also, if you're a contrarian investor, you want to look at investor and trader sentiment, and you want to do the opposite of it. So macro charts here did a good job of charting the AAII investor sentiment. And what they do is they take the bullish sentiment, subtract the bearish sentiment, and they're pointing out recently that right now the reading is among the lowest in more than 30 years. So you can see we're way down here. It's basically the lowest sentiment reading, or the most bearish sentiment reading that we've had since March of 2009, which is quite extraordinary. And so the typical way you would trade these sentiment surveys is to fade them, and you would take this as a bullish signal, saying investors are too bearish, they're underinvested, and so one should fade this and one should be long stocks. And I've heard a lot of people say, with the yield curve inverting and everyone talking about recession, if a recession does happen, this will be the most widely anticipated, watched recession in history. So these are all bullish arguments, the sentiment indicator and the fact that we're so close to highs here. Now let's take a look at the bear side. The really bearish side of this is that in the wake of the WeWork S1 and their announcement about their IPO, and they're subsequently just getting completely trashed and going from a valuation above 60 billion to now talking about IPOing below 20 billion and maybe even canceling the IPO completely, that has begun to really weigh on tech stock valuations, especially recent IPOs. That combined with the really terrible performance of some of the big IPOs of the year, Uber trading near the lows since it became public, Slack, WORK, hitting new all-time lows today for its public market trading, and then Lyft, LYFT, also hitting new lows here. So there's been this combination of kind of a re-rating in valuations, and it's really you can see it's just killing software stocks today, and it's especially hitting all the stocks that we've been trading the last few, I'd say the last 12 to 18 months. So I mentioned that I was really lightening up on stuff and using that 50-day moving average as a trailing stop. I hope you guys have been doing that too. I hope you've been playing good risk control here. We'll just take a quick tour here through a lot of these momentum stocks that are breaking down. And I think this is a very bearish sign. So Zscaler, ZS, melting down. CRWD, CrowdStrike, down 12% today. Zendesk, more recent IPOs like Smartsheet, just getting completely hammered. We have favorites like Trade Desk, TTD, Coop, COUP, and Ulta was another one that's been breaking down really since earnings. Vive. So these are very important momentum names, and there's a lot of money coming out of these today. Even Roku, which we talked about last week, has had a pretty bad reversal candle today. So if you're long any of these names, make sure you know where your stop loss is, and make sure you act on that stop loss. You can't trade momentum stocks without a stop loss. So, and there was one name I mentioned last week as well. ASPS is a nice hedge against a recession. That is sort of moving inversely, just as we would hope, up 6% today. So hopefully some of you guys were able to pick that up as well. Again, telling you what I'm trading. These aren't investment recommendations or anything. So how do we square this circle? How do we reconcile the fact that we're trading at new highs here? Sentiment is very bearish, and yet all these momentum names, these sort of stock market leaders, are breaking down. When stock market leaders break down, that's a sign you've got to be very careful. So Shopify is another one that just had a tremendous run, down almost 25 points today. So real pullback here. Well, I would say that I think the trade war is not going to be resolved anywhere soon. I would say September is a very bearish month. And I think this combination of whipsaws from Trump's tweets and all the news flow, combined with a re-rating in tech, especially software valuations, I think it's very bearish for the market. And I think one reason that we have these surveys that saying that we have surveys saying that investor sentiment is bearish, but the fact remains that a huge percentage of the stock market, this article says 45% of all assets, are based on just tracking indexes, completely passive. I would think it's much higher than that, because you have a lot of shadow indexers who are basically tracking the S&P or the triple Qs, either in hedge funds or mutual funds or other institutional funds, and everyone is indexing. A huge percentage of the market is indexing right now, and so I think in this environment of passive investing and indexing, I think the sentiment indicators become less useful. So I would really want to question all these people who responded to the AAII investor sentiment survey. Have they exited their retirement holdings? Have they sold their SPY or their QQQ or their DIA? Especially because there's so many assets being held in retirement accounts and in 401ks. And I would guess that they haven't. What this might mean is they're marginally buying less. But I think the whole world is indexed to the indices. And just as they've followed it up, they will also follow it down. So I'm being very careful out there. You guys should really examine your risk exposure. This may be a false alarm here. Obviously, we're going to pay a lot of attention to price action. If we get a quick snapback in these software names, if the S&P 500 or the QQQs, if we see these trading at new highs, again, if we see strong leadership from the FANG stocks, you can see Netflix has been extremely weak. Amazon holding in there, and Apple probably the strongest of all of them. If we begin to see the price action indicate otherwise, I'm willing to revise my hypothesis. But I think things are looking bleak going into the end of the year. So I'm really controlling risk here, and I hope you will be too. If you enjoyed this video, be sure to hit that subscribe button and let me know your take on this. Are you a bull or a bear? You think we're heading into a crash here, or a melt up, or maybe just an extended sideways market? That could be the other possibility, where the market chops around within a trading range in a very volatile way. There aren't a lot of good trends, in which case trading becomes a little bit more difficult, and you want to play the ranges, and you want to buy near the lows of the ranges and sell near the highs of the ranges. And we could talk more about that in another video if people are interested. Be sure to hit that like button. Thanks a lot for listening, and I'll see you in the next video.